Thank you, Chair. Thank you, Governor. Do you agree that the neutral rate could be pushed higher by growing fiscal deficits?
So the neutral rate is basically determined pretty much by relative supply and demand for funds, so savings and investments, if you like. And it's also influenced by what happens with the global rate, so global savings and investment. Prior to COVID, there was a feeling that the global neutral rate, including in Australia, was quite low because there was quite a lot of savings in the world economy, not as much investment. So if you take that sort of framework and you think about government deficits worldwide, then there is a possibility that if you have an increase in investment at the same time as you've got less savings in total, then that might have an impact on the neutral rate upwards.
So, in simple terms, all else being equal, higher fiscal deficits could mean a higher neutral rate.
They could, but I emphasise again that there's domestic factors here, but there's also global factors.
Of course. We don't control global factors, though. The only thing Australians can control is Australian factors. So is it fair to say that, again, taking all else being equal, that higher fiscal deficits in Australia could push higher the Australian neutral cash rate?
All other things equal, if there is less savings in the economy, and that includes by the government as well as by the private sector, and at the same time investment doesn't come down, so all other things equal, then that would put a bit of upward pressure on the neutral rate.
Okay. You probably know I'm alluding to a speech given by the head of the International Department at the RBA, Penelope Smith, last week, which she argued that could be one of the factors pushing the neutral rate higher in Australia. That also means, all else being equal, that interest rates need to be higher. You, as the RBA, need to set interest rates higher in order to stabilise inflation, isn't it?
It means that if we want a restrictive policy, it means that the cash rate has to be set higher than a higher neutral rate. So, yes.
So last year, the Australian government had a deficit of $10 billion, and this year it's forecast to be $42 billion. If the deficit was instead there was no deficit, or the deficit was much lower, that would mean the interest rate could be lower, all else being equal.
Possibly, but we've got models of the neutral rate, which and they take into account these sorts of things. I might let Dr. Kent speak about this, but there's a wide range, so I don't think you can make a statement that says take $10 billion off, neutral rate does X. So, Chris, did you want to?
I think it depends as well what's happening on the investment side, and we need to think about both federal and state governments.
Yes, that's a very fair point. What I'm just trying to do is just isolate this factor, though. That's why I keep saying all else being equal. It's very common in economics when you're trying to assess the impact of a policy change to assume all else is equal. So let's assume all else is equal. And I'm not asking you to specify exactly how much lower interest rates would be, but if we were not projected to have a $42 billion budget deficit this year at the federal level, take your point about state deficits, but let's assume they're all else be equal. If that instead was a lower number, or indeed a surplus, then interest rates could be lower, couldn't they?
I think in theory, yes, at the margin, all else equal, but the reality is the bigger fiscal pressures are coming from offshore, and that's having an effect on global neutral interest rates, and that's reflected somewhat in ours as well.
Yep. We might come to that in a minute if we have time. In the most recent quarterly print, which I understand is reflected in your latest forecast, both underlying and headline inflation is back above your target band, and again, as I understand, your forecasts say that it will remain above the target band now until 2027 and not return to the midpoint at any time within the forecast horizon. Is that right?
That's broadly right, I think. Let me just check the... our target is, as we've said before, our target is headline, but given what's happening with rebates for energy in particular at the moment, it's a bit difficult to read. So that's why we've been focusing on trim mean. So I think our current forecast, November, we see headline inflation coming back in the band in 2027, and back towards the midpoint by the end of the forecast period, 2027.
Okay, but not actually back at the midpoint by the end.
It's not back at the midpoint, but it's back 2.6. And given how uncertain forecasts are outside that far out, Senator, you'd understand that 0.1
Yep.
is 0.1.
Fair point. I think Senator Hume will have some questions about Nauru in a minute, but just for our purposes, it's the RBA's view, isn't it, that the current unemployment rate is below the natural rate of unemployment?
We think the labour market is still a bit tight. I try to steer away from talking about a single number like the Nauru, because, as we've said before, there's a whole lot of things that we look at to judge that the labour market is a bit tight. That is one of them, and the model estimates of that is one of them, but there's a whole lot of other things as well. So I would characterise it as saying we think the labour market's still a little tight.
Okay, I'll leave Senator Hume to get into that into more detail in a minute when she has the call. But would it be fair to characterise the economy today as operating above its potential?
I think at the moment we feel that it's a bit uncertain. We think that the output gap probably has closed, but it is uncertain. But it does mean that we're in a position where, even if we're in balance, that there are upside risks if the economy grows a bit quickly, if we're already at potential. So that's sort of the issue we're dealing with.
All the recent data, correct me if I'm wrong, has surprised on the upside. Inflation has been higher than your forecast and Treasuries. Is that right?
Certainly inflation has surprised on the upside. The unemployment rate hasn't. The unemployment rate's pretty much come in as we expected. And then, of course, we're getting some data at 11:30, which will tell us how the economy went in September.
Yeah, but if unemployment is roughly where you expected it to be, but inflation appears to be accelerating, that does indicate that perhaps the economy is operating above potential?
Possibly, but there's some other possibilities as well. There's certainly some suggestion that what we were observing through the middle of 2025 was a little bit of pressure on business margins that maybe now are recovering. So it's suggestive that costs are biting on businesses and they're able to pass them on. It doesn't necessarily mean that we're operating beyond potential, but it does mean that demand is recovering enough to allow businesses to pass on cost increases.
Yeah. Whether it's kind of in balance or above potential, I think either way, what would you assess the impact of a positive demand shock to be?
Well, a positive demand shock, if we are already at balance and demand increases much more sharply than we'd expected, then we might expect that would put a bit of upward pressure on inflation.
Yep. So I want to take you to some recent statements on monetary policy. I was going to provide you a copy, but I see that that's going to be technically difficult given where you are, but I'm sure you've got access to them. In the November 2024 statement on monetary policy, it states, and I quote, "Growth in public consumption is expected to remain robust over coming years, supported by the provision of government services to households." And it goes on to say, "Growth in government spending has been stronger than expected, driven by public consumption. The staff forecast of public consumption has been revised higher several times over the past year in response to announcements of additional spending." In brackets, the staff forecast does not typically incorporate expenditure that's not been budgeted. So again, all else being equal, if the economy is either in balance or above potential, what's the consequence for inflation and interest rates when there's a positive shock to government spending?
Well, again, in theory, what happens is that if you end up with total demand in the economy above what we're forecasting there, that would suggest our forecasts would, depending on supply and our assumptions about supply, that we would expect that inflation would be a bit higher.
In the May 2025 statement on monetary policy, there's an observation which I'll quote, which is public demand accounted for around half of GDP growth in that quarter. So if we rely on the government's latest forecast from the budget for spending in the current financial year and their nominal GDP forecast for this financial year, nominal GDP has increased by a bit over $300 billion in the last 3 years, and government spending, federal government spending, has increased by about $150 billion. So around half of all additional GDP in the last 3 years is accounted for by federal government spending. Does that sound right?
Oh, look, I accept your numbers. I haven't got the specific numbers in front of me, but year-end.
Probably about right.
About right, probably.
Yep. Okay.
A bit less than half.
Yep.
But not much.
So, I mean, half of all GDP growth being attributed to federal government spending is a significant proportion, isn't it?
Yes, but if you, I mean, government I've made this point before. Government sometimes, in circumstances where, and if you look back over GDP growth and the contribution of public over the last few years, in times when private demand is not doing very well, often what happens is the public demand comes in to fill the gap. And that's certainly what we've observed over a number of periods in recent years.
Sure, but I mean, federal government spending as a proportion of the economy is roughly about a quarter and has been roughly about a quarter for 20 years, add or subtract a point or two. If in the last few years federal government spending has accounted for half of all economic growth, that's a very significant increase.
That's a contribution to GDP growth, and that moves over time.
Yeah.
And it depends very much on what's happening to the private contribution. And if the private sector is not contributing much in a cyclical sense, say it's in recession, then you would expect the public sector to be accounting for more of the growth. That's a cyclical phenomenon.
Sure. Is it a sustainable phenomenon?
Well, no, it's a cyclical phenomenon.
And that's why I'm asking it. Would it be sustainable?
Well, it's not really a point of being sustainable as the economy picks up, and what would generally happen is, in a cyclical sense, is that it would decline as a share of contribution to growth.
And we had a discussion at the last round of estimates about a private sector taking over as the leader of growth. Is that what we've seen?
Well, we're starting to see it, and our forecasts are that we will continue to see it, and it will pick up. Yes.
I think the discussion we had that private sector would be taking over from the public sector, but in the June quarter, public demand grew by 1%. In the most recent statistics of government financial statistics released yesterday, growth in public demand has actually doubled to 2.1%. So it doesn't seem to me like government is taking a backward step and the private sector is taking over, at least not yet.
But we'll wait and see at 11:30.
Yes, indeed. We don't have long to wait. All right. I think the chair's about to round me up anyway, so I might leave it there. Thank you.
Thank you, Senator. Senator